Last week was messy. We saw unemployment drop, then we saw inflation run hotter than people expected, and now the rate hike chatter is back, loud and everywhere. So naturally, the internet has gone straight to the biggest question of all. Is 2026 the year the property boom finally snaps? But here's the twist. Right in the middle of all of this noise, two of the biggest research teams in the country have released fresh 2026 forecasts for Australian property, and they built those forecasts around the exact thing everyone is panicking about right now, which is rate uncertainty, including the risk that rates rise again. I'm talking about KPMG and AMP, two highly respected research groups. I read through their numbers this morning and I'm telling you, it stopped me in my tracks because the timing is wild. The confidence is wild, and even though they are independent, the direction of their forecast lines up in a way you do not see very often. And they did not just give a broad national view. They went city by city and they laid out what they think happens in 2026 and what they think happens in 2027. So stick with me because there are a few cities in here that are being tipped to keep ripping, to keep growing, and there are a couple where the story starts to fade fast. And in one case, the market could get extremely ugly. Quick one before we jump in. If you want daily property and economy updates without the drama, hit subscribe and hit the bell and then come straight back because this forecast is going to spark a lot of opinions. All right, let's get into it. Before we get into the numbers, we need to talk about why this moment matters. The housing debate in Australia has basically split into two camps. One side says the housing shortage is getting worse, demand is still there, and prices keep finding a way up. You see it in the headlines every single week. Perth pushing into new territory, Brisbane is hitting new highs, and even the so-called quieter markets are suddenly picking up pace again. The other side is saying, none of that matters if rates go up. They believe once the RBA starts hiking again, the market has to slow, because in their mind, higher rates equals lower prices. Now, I covered the rate story in my rate cut video last week, so if you want the bigger picture on what rates can and cannot do to property, go and watch that video after this. But this video is different, so stick with me. This video is about what two heavyweight forecasting teams think happens next, even with rate uncertainty sitting in the middle of this conversation. So let's start with KPMG. Now, KPMG's national call for 2026 is bold, and it is one of the reasons the media ran with this so hard. They are forecasting strong growth across the country, but the real story is not the national number. The real story is the gap between the cities. Because KPMG is basically saying Australia is not one market, it is a bunch of different markets moving at different speeds for different reasons. Now, this is the part you might have already seen floating around online. KPMG's forecast implies Brisbane house prices rise close to 11% in 2026 and then close to 9% again in 2027, which is basically more than 20% lift across 2 years. That is not an error. That is the kind of number that makes people sit up because it is nearly double what they are forecasting for Sydney. And then you look at Perth, and KPMG basically has Perth as the main character again. They are tipping Perth as the strongest performer in 2026, and it is not even close. Now, Adelaide is still expected to grow strongly too, but KPMG is also hinting that Adelaide is starting to run into affordability limits. And once affordability starts biting, demand does not vanish, but it changes shape. Buyers start looking for cheaper pockets, cheaper stock, and sometimes cheaper cities. And now we need to talk about the one city that a lot of people have doubted for years, Melbourne. KPMG has Melbourne houses up 6.8% in 2026 and 7.3% in 2027, which is roughly a 14% lift across 2 years. It's a bit more than that when you compound it. And this is where I want to pause, because if you have been watching this channel for a while, you have heard this theme before. Liana and I have been saying for a long time that Melbourne has been a sleeping beast. It has been held back, it has been ignored, it has been written off, and when it finally wakes up, it does not creep, it will move quick. So when you see a major forecaster start saying Melbourne's rebound is being driven by real underlying demand and that its lower price base gives it room to run, this is not random. That is a major signal that the market is starting to move. And then they have the bigger, more expensive city like Sydney growing, but more moderately, because affordability limits now have been really stretched in Sydney. Now let us bring in AMP, because AMP looks at the same market, but they frame it a little differently. AMP is also forecasting ongoing growth in 2026, but they deliver it with more caution. They basically say yes, prices can keep rising, but the pace is likely to cool compared to 2025 because affordability is stretched and lending standards can tighten. AMP's explanation is also important because it matches what we have seen in real life. They say the rate cuts from 2025 take time to flow through the economy, and even after the cuts happen, the impact shows up later through borrowing power, buyer confidence, and behavior. They also point to government buyer incentives, and they make a simple point that most people miss. When the government gives buyers easier entry, those policies do not just help people, they pull demand forward, they create urgency, they drag buyers into the market earlier than they would have moved otherwise. And then AMP hits the biggest point of all, the housing shortage. They are saying we still have a deep shortage of homes, and until supply actually catches up, prices and rents stay under pressure. So AMP is effectively saying there is a reason the market stayed stronger than expected in 2025, and a lot of those conditions do not suddenly disappear just because the rate narrative changed this month. Now, before you take these forecasts and start treating them like gospel, both KPMG and AMP attach a very clear warning label. And this next part is where the real story sits. Both KPMG and AMP are basically saying our forecasts work as long as the foundations underneath the market stay in place. So what are those foundations? First, supply stays tight. And honestly, nobody serious is expecting supply to suddenly flood the market in 2026, 2027, or even 2028 or beyond. New houses do not turn up because someone writes a press release. It takes years, it takes approvals. You need the skilled labor, it takes builders, it takes tradespeople, it takes councils. And right now, every level of government is tripping over each other, and the system is jammed with red tape and slow delivery. Even if someone announced a miracle plan today, it would not change 2026, 2027, or even 2028 in a meaningful way. Second, population growth stays strong. And again, nobody's expecting Australia to suddenly slam the door shut. They might change the mix, they might change the pathways, they might tweak the rules, but high migration settings are still part of the national plan because the economy is built around it. So if supply stays tight and population stays strong, the shortage will stay real. Third, the labour market stays reasonably tight. Unemployment has actually dropped quite significantly from 4.3 to 4.1% on the latest monthly number. Even if the RBA lifts rates and unemployment moves up a bit, say to 4.3, 4.4, that is still an incredibly low unemployment rate. And when people keep their jobs, forced selling stays limited. Households tighten spending, they cut back, they adjust, but they do not panic sell in big numbers. And for the market to move backwards, we need to see panic selling, which we will not see. And there is one more piece people forget. Most variable rate borrowers are actually ahead on their repayments, which gives them a bit of breathing room if rates do tick up. It does not mean life is easy, but it does mean a lot of borrowers are not on the edge the way the headlines make it sound. Now, the last assumption is the one everyone is obsessed with, interest rates. And this is where the debate gets spicy because a single rate hike creates hesitation, but a full hiking cycle changes the whole game. And right now, even the big banks are not talking like we're going to see an extended long hiking cycle, which we saw before with 12 rate increases. In fact, most of the big four have shifted to a one hike view. CBA, Westpac, and ANZ are expecting 125 basis points hike, while NAB is saying maybe 2, February and May. So the market is not pricing a runaway rate spiral. It is a pricing move and then a pause unless inflation forces something bigger. And that difference matters because one move can slow confidence for a while, but it does not automatically smash the entire property market. So what does this actually mean for 2026 and 2027? So let us pull this together. When you look at these forecasts side by side, you see why they are causing such a reaction. They are coming out during peak uncertainty, they are building in the rate risk, and they are still pointing to a market that stays strong overall, even if some cities run harder than others. KPMG is basically saying the strongest growth stays concentrated in the smaller capitals and the boom markets like Perth and Brisbane, and they also signal that Melbourne will start to build its momentum and see growth. AMP is saying growth continues, but it slows because affordability and lending rules start acting like a brake. And both of them are saying the real driver underneath all of this is not vibes. It is the housing shortage. Now, does that mean every city booms and nothing can go wrong? No. Does it mean every suburb will boom? Absolutely not. There are 15,000 suburbs across Australia. You've got to know which the top ones are if you're going to be a successful property investor. But it does mean the market stays uneven. Some cities keep ripping because they still have relative affordability and strong demand. Some cities cool because affordability has pushed buyers to the edge. And some pockets, especially at the premium end, can absolutely weaken if rates rise and sentiment turns, because bigger loans get expensive faster. But the bigger picture, based on what these forecasting teams are saying, is that 2026 is not shaping up like a clean crash story. It looks more like a bit of a reshuffle. A market that stays strong overall, but rotates, splits, and punishes the wrong segments while rewarding the right ones. So if you understand the data and you understand the trends, out of 15,000 suburbs, you will be able to find the right ones for your investment or for your first home if you want to see growth on the property. And this is the part that should make you stop and think. Right when the internet is screaming the boom is over, two major forecasting teams with access to deep data and serious modeling are putting out numbers that suggest the story is not that simple. And in some cities, the next 2 years could still be very strong. Now, I want to hear from you. Do you think KPMG and AMP have nailed it? Or do you think they are underestimating what rates and affordability can do in 2026? Drop your view in the comments because I read them all. And if you want daily property and economy updates so you can stay ahead of the market, hit subscribe and hit the bell because I do these videos every single day. This was your daily property update, your 5 to 8 minute breakdown on the economy and property so you can stay ahead of the market and become a property insider. See you at the next one.